Today, Venezuela is more than a cautionary tale. Its situation acts as a geoeconomic flashpoint. With the U.S. asserting control over its oil revenues and supply chains, global power dynamics shift. Traditional alliances, such as Venezuela's long-standing economic ties with China and Russia, are now under strain. China, which has significant investments and strategic interests in Venezuela, has publicly criticized U.S. actions as attempts to undermine its regional influence. Meanwhile, Russia sees the episode as part of intensifying great power competition, further complicating an already fragile global energy landscape. In essence, what was once an isolated economic and political crisis has become a symbol of the broader battle over global resources, trade systems, and financial dominance. The world economy now watches to see whether Venezuela's vast oil reserves will finally be integrated into the global market in a stable way, or whether political tensions will fracture trade flows and fuel further instability. The capture of Nicolás Maduro is not just another news headline. It represents a potential turning point in the global economic order, one where control over energy resources, financial systems, and geopolitical alliances could be reshaped for decades to come. And it is precisely this convergence of energy wealth, strategic competition, and financial infrastructure that defines the $3 trillion Venezuela trap, a term that captures both the promise and the peril of Venezuela's place in the modern world economy. With Nicolás Maduro now in U.S. custody, the world has entered uncharted economic territory. Part 1 explored Venezuela's enormous untapped oil potential and the historical dysfunction that has kept it from reshaping global markets. Part 2 focuses on the immediate and medium-term repercussions for international finance, energy, and geopolitical alliances. The arrest of a sitting head of state is unprecedented in modern economic history, and the reverberations are already shaking global institutions. The first and most obvious shock is in oil markets, where Venezuela's crude is both a critical physical commodity and a political instrument. Analysts immediately began recalculating global oil supply-demand balances. If U.S. companies or international consortiums gain operational control over PDVSA, Venezuela could potentially ramp up production by 500,000 to 1 million barrels per day within the next 12-18 months, even accounting for damaged infrastructure. Oilprice.com. This increase would ease pressure on markets still recovering from recent production cuts by OPEC Plus nations, potentially lowering crude prices in both the short and medium term. However, the consequences are not solely economic, they are deeply political. Venezuela has historically been an ally of nations like Russia, China, and Iran, all of which view the Western-dominated financial system with suspicion. By asserting control over Venezuela's resources, the United States sends a signal. Strategic energy assets will be leveraged for both economic and geopolitical influence. This shift may encourage rival powers to seek alternative supply chains, form new alliances, or accelerate efforts to bypass dollar-dominated trade. Another layer of complexity is legal and financial risk. Maduro's arrest is already triggering numerous lawsuits and claims against Venezuela's foreign assets. Nations and private entities that hold Venezuelan bonds or have contracts tied to state-owned companies like PDVSA face uncertainty about repayment schedules and enforcement. Legal scholars warn this could trigger a cascade of defaults if creditors suddenly lose confidence in the state's ability to honor commitments. Bloomberg.com. The potential losses could reach hundreds of billions, further complicating the $3 trillion trap scenario, which hinges on Venezuela's total economic exposure, including resources, debt, and latent market influence. The international banking system is also at risk. Venezuelan oil payments have historically flowed through U.S. dollars, with many transactions cleared through American or European financial institutions. By taking control of Maduro and effectively the state's revenue streams, the U.S. can dictate where these dollars go and how they are used. While this might stabilize some markets, it could destabilize others. Banks in China, Russia, and other countries may see their exposure to Venezuelan contracts suddenly at risk, potentially forcing them to hedge aggressively or divest, creating volatility in global financial markets. FinancialTimes.com. Energy-consuming nations also face strategic dilemmas. Europe, for instance, has been gradually reducing reliance on Russian energy following geopolitical tensions. Venezuela's oil could serve as an alternative, but political instability complicates long-term contracts. Meanwhile, emerging economies in Asia and Africa that previously relied on Venezuelan energy at discounted rates may face supply shortages or pricing uncertainty, forcing them to pivot to higher-cost sources. These shifts can inflate costs across global supply chains, influencing everything from. Meanwhile, the currency markets are beginning to reflect broader geopolitical risk. The U.S. dollar initially strengthened as investors anticipated greater control over Venezuela's oil revenues. But currencies of commodity-importing nations experienced turbulence, For countries holding large amounts of Venezuelan-linked debt or imports, the dollar-denominated cost of purchasing goods could rise sharply, exacerbating inflationary pressures in already fragile economies. CNBC.com. The political ramifications extend even further. In Latin America, neighboring nations are now reevaluating their relationships with both the U.S. and Venezuela. Colombia, Brazil, and Mexico face a delicate balancing act, aligning with U.S. interests to ensure stability in oil supply, while avoiding domestic backlash for supporting what some see as an aggressive intervention. Simultaneously, countries that previously leaned toward Maduro's government, such as Nicaragua and Bolivia, may resist U.S. pressure, increasing regional tension and the risk of proxy conflicts. BBC.com. Even global energy investors are recalibrating. Hedge funds, sovereign wealth funds, and private equity firms are rushing to analyze potential revenue streams, infrastructure opportunities, and political risks. Some see a chance to profit from rehabilitating Venezuelan oil infrastructure, while others worry that legal disputes, social unrest, or sabotage could wipe out investments. The sheer scale of capital needed, tens of billions to modernize refineries and pipelines, means that only major multinational players can realistically participate, further centralizing control and influence. Technology also comes into play. Venezuela's heavy crude requires advanced extraction and refining technology to meet global market standards. Western firms with expertise in this field are now uniquely positioned to benefit, but the transfer of such technology carries long-term geopolitical implications. Whoever controls the technological know-how effectively controls Venezuela's oil output for decades, solidifying influence over both energy markets and financial flows. Meanwhile, citizens within Venezuela face uncertainty. While Maduro's removal may eventually open opportunities for economic stabilization, the immediate aftermath involves administrative chaos, protests, and potential backlash from remaining loyalist factions. Social unrest could disrupt production, delay foreign investment, and even threaten infrastructure security. Humanitarian aid, previously constrained by political disputes, may also become entangled in the larger geopolitical game, affecting both food security and medical supplies. Reliefweb.int. Finally, Part 2 would be incomplete without noting the psychological impact on global markets. Investors often react not only to material changes, but to perceived political stability. The unprecedented arrest of a sitting president, compounded by uncertainty over Venezuela's economic management, has created a fear premium in commodities and equities. Market volatility, credit default swaps, and speculative trading are all increasing as stakeholders attempt to price in the many unknowns surrounding Venezuela's next moves. In conclusion, the capture of Nicolás Maduro has far-reaching consequences that extend beyond Venezuela's borders. From oil markets and currency fluctuations to geopolitical alignments and technological leverage, the world is grappling with a realignment of influence. The $3 trillion trap is not just a theoretical calculation of oil and debt. It's a living, breathing geopolitical and financial puzzle, one that has the potential to reshape energy markets, financial institutions, and global alliances for decades. As the dust settles, the coming months will reveal whether Venezuela becomes a stabilizing force under new influence or a further destabilizing factor in an already fragile world economy. As the world enters 2026, the capture of Nicolás Maduro represents more than a historical event. It is the opening chapter of a complex economic saga with implications for decades to come. Part 1 analyzed Venezuela's massive oil potential and the $3 trillion trap of untapped wealth, while Part 2 explored the immediate economic, political, and financial shockwaves across global markets. Part 3 focuses on the future, the potential scenarios, risks, and opportunities that lie ahead for Venezuela, its neighbors, and the broader world economy. First, let's examine the energy landscape. With U.S. and Western firms now positioned to manage Venezuela's oil infrastructure, there is potential for a dramatic increase in production and exports. Estimates suggest Venezuela could, within 5 years, restore up to 2 million barrels per day, providing a critical supply cushion for global markets. Such an expansion would likely lower oil prices, benefiting energy-importing nations, while simultaneously reducing the strategic leverage of traditional producers, such as Saudi Arabia and Russia. Oilprice.com. However, restoring production is easier said than done. Decades of underinvestment, outdated refineries, and dilapidated pipelines require billions in capital expenditure. International investors face not only technical challenges, but geopolitical risk, as remaining loyalist factions or foreign actors may attempt sabotage to disrupt production. Venezuela's future as a stable energy supplier depends as much on political stabilization as it does on financial investment and technological upgrades. Thank you for watching, and remember, the world's biggest economic stories are often hidden in plain sight, and Venezuela's trap is one you want to ignore.